My name is Richard August, and I'll be your host. Our guest is Derek Amey, partner and co-chief investment officer at Strategic Point Investment Advisors with offices in Providence and East Greenwich. Welcome back to State of the State.
Hey, thanks for having me.
And in full disclosure, I would like to say that Derek is my financial advisor. Let's begin by talking about what the stock markets are doing as 2022 draws down to a close. The widely watched S&P 500 index is down 19+% for the year, and the more quoted Dow company, large company index is down 9.4%. The tech-heavy NASDAQ has fallen 31.6%, and on top of this, the Federal Reserve Open Market Committee jacked the federal funds rate up by 0.5% to somewhere between 4.25% and 4.5%. Look in your crystal ball and tell us what the outlook is for 2023.
Put me right on the spot, right out of the chute.
Right out.
Look, it's been a challenging year. I think one of the more harder things for people to digest in a year like we just had is the correlation of everything went to one. For much of the last 10 or 15 years, stocks had a good year. Bonds would be okay. Stocks had a bad year like 2008. Bonds actually did well. And this year, there's been nowhere to hide. Obviously, the bond market's been heavily impacted by the Federal Reserve raising rates. And the stock market is looking at things like profit margins because now borrowing money is more expensive, hiring people is more expensive, input costs are more expensive. And at the same time, this may be a shock to people, but the Federal Reserve is trying to put people out of a job, right? Part of the fear is that wage inflation is a big source of the inflation that we're all experiencing. And one of the ways that you can do that is to try to slow down the growth in the job numbers. And so that does really mean, maybe people getting laid off or at least not having as many job openings. But again, when we are retaining employees or hiring new employees, it costs more money.
Well, in that regard, Bloomberg News regularly polls 70 economists. And their latest consensus is there is a 70% chance of recession in 2023, which is double the rate of the consensus 6 months ago. And what you're pointing out is this wage push type of inflation. The way it can be controlled is by layoffs, terminations, whatever, early retirement programs. And I mean, that hurts a lot of people, but that seems to be the way it's going. What do you think about that prognostication?
Yeah. So let's pause for a second and go back, right? When was the last time this country had really high inflation?
Well, I can remember when it was 18%.
Yeah,
Jimmy Carter.
Late 70s, early 80s. I'm in full disclosure, I'm 47, right? My generation, anyone younger, doesn't know what inflation is until the last, basically, 12 months, right? It just never existed. It was a boogeyman that we've all learned about in Econ 101, but we've never actually lived through it. What happened the last time we had record high inflation? The Fed chair back then, Volcker, came in and said, I know how to fix this. It's not going to be fun, but I can end inflation. President Reagan, how are we going to do that? I'm going to drive the economy into a recession. So we only have a sample size of one, meaning Wall Street is looking at that time period as basically the roadmap for what we're dealing with now, and is saying, okay, I've seen this movie before. Granted, it was only once, but we're going to use that as the roadmap. So many people are prognosticating that the only way we're going to really kill inflation is we're going to have to cause a recession. What Wall Street's trying to figure out is two things. Is it going to be deep and painful? Is it going to be shallow? And or how much of that recession is already priced in because stocks have already had a bad year? I can't possibly sit here and figure that out, and no one can efficiently. Certainly some of it is factored in. That it's not normal for stocks to be down 20-25%, which is what we did see earlier in the third quarter, where stocks were down over 25% year to date. But some of that's priced in. What we're trying to figure out is, well, how much of that? And is it going to be a deep recession? Again, anyone under 45, the recessions we've lived through, 2008, that was a really, really bad recession. That was a financial crisis wrapped up in a recession. 2001, okay, we had the dot-com blow up with a recession. All we know is deep recessions. Your generation, boomers, there have been softer or shallower recessions, but it's been since the early 1980s since we've had one of those. And The reality is, if you know which one we're going to get, a shallow or a deep one, the stock market becomes a little bit easier to guess on what kind of outcome it's going to be. If it's going to be deep, we're probably going much lower than we are right now. If it's going to be shallow, well, maybe that's already priced in, and that's what people are trying to figure out.
Of course, if someone decides to liquidate their stock and bond holdings and sit on cash, as the inflation rate continues, that cash, the value, the purchasing power of it shrinks. However, if you leave it in the one of the markets or both markets, then you have the opportunity for recovery once the economy recovers. Is that a fair statement?
Yeah, I mean, what we like to tell people, especially newer investors, younger investors who may not have a deep knowledge on how the market works. Look, the stock market tends to return 9 to 10% per year. The problem is that's over a full business cycle, and it's not going to come in lockstep, and it's not going to be the same every single year. Obviously, we're living through a year like this where that's not accomplished. If you start trying to liquidate and then get back in, you almost have to be right twice, right? You got to get out once and then know when to be smart enough to get back in. And having done this for over 20 years and having seen people try to unsuccessfully do that timing, some of them get the first part right. It's the second part that gets challenging, which, let me delve into a little bit into your question before. The stock market tends to bottom before a recession is over. It's a forward-looking mechanism. Even in 2008, the market actually bottomed before the economy did because it started to see, okay, things are not accelerating. Yes, we're not out of the recession, but there is light at the end of the tunnel. And for most mortals who are trying to time the right way to get in and the right way to get out, the news is still going to be bad when the market starts to bottom, and what it's seeing is the rate of change isn't accelerating anymore and stocks start to come back.
The Fed's stated goal is a 2% annual inflation rate. Does that mean that we'll see more increases in the prime and Fed funds rate?
So that is the sort of $64,000 question. Right now, Wall Street is forecasting that we're going to get at least one more rate hike, but it's probably going to just be 25 basis points, so that'll be half. For those of you listening, the Federal Reserve had been raising at 75 basis points.
0.75%.
Correct. This last one, they only did a half, and then the assumption is we're going to get another 25 basis points. But let's talk about that. We're going to get CPI in January and another CPI in February before the Federal Reserve actually meets. So there's a gap in their meetings. Mm-hmm. So the assumption is they're going to go slower because the January report and the February report will show this recent trend that inflation has peaked. They're assuming that it will continue to show that. I can't sit here and predict that with 100% authority, but I think one of the other things that Wall Street's trying to figure out, okay, we peaked at 9, we're at 7, the trend is in the right direction. Where does it start to get hard? Did you ever golf? Were you ever a golfer?
Mm-hmm. Once in a while.
So if you think about, you take someone who's never golfed, they're going to be horrible. But with 1 or 2 lessons, you can make them okay. But if you want to make them PGA level, it gets harder and harder, right? Those are the elite of the elite. What does that have to do with inflation? The move from 9% inflation to 4% probably isn't going to be that hard. But if you got to wring out that last 1% or that 2%. Last 2%, or you got to shave those last 2 or 3 strokes, which makes you go from an average golfer to an excellent golfer, it just gets harder and harder. So we're sort of assuming, the move from 9 to 4, which probably will happen over the next 6 months as we, get into the summer, that's probably okay, because you can look at things like gas prices are down, rents are coming down, car prices are coming down. There's a lot of things that are trending in the right direction. It's just a question of, okay, trending in the right direction is one thing. Are they going to, accelerate, or are they going to start to slow down at some point? We're just not sure.
You talk about car prices, as most people watching this will remember or know, used car prices skyrocketed because of the new cars weren't on the lot. So, the used cars became more and more valuable, or more costly, I guess, or expensive. I think they've fallen almost 3% now from the high.
Yeah, and there's also some other things where, now I think I saw the other day the average interest rate on a new car for even people with good credit can sometimes be 7, 8, 9%. Now, you and I would fall out of our chair. 7, 8, 9% for an auto loan, where just pre-pandemic, it wasn't unusual that you could get someone offering you 0% financing. As that cost of money has gotten more expensive, it can't help but have an impact on the economy, and auto sales are obviously a big thing. Right. But the prices, yes, have started to come down because auto dealers are realizing not everyone can afford an 8%, auto payment.
Well, the home construction is obviously affected by these rates, and as well. And I heard an interesting concept that some of the residential real estate developers are offering something called a 4-3-2-1 mortgage. And what that is a very unique thing, is that let's say the mortgage rate at the time today is 7%
Sure.
for a 30-year mortgage.
Yep.
They discount it by take 4 percentage points off that the first year. So you pay 3%.
Okay.
The next year, take off one less, so it goes up, gets back at year 5 to the full 7%. So some people are looking at this and saying, yeah, we're going to see a lot of foreclosures in year 5 because the people that are saying, oh, this is a good deal, I only have to pay 3%, aren't going to be able to afford 7. So all of these financing gimmicks carry with it a risk, and I'm sure what's happening is some of these people are being advised that, don't worry, 5 years from now, mortgage rates will be down and you can refinance.
So as you were sitting, I hadn't heard of this. I do know, some of the major home builders are trying to find creative ways to get they're in the business of building homes and selling homes, so they're going to try to find creative ways to get in it. What you're actually describing is just an ARM, right? Adjustable rate mortgage. It's being done by the person who's selling you the house as opposed to a traditional financing. But if your mortgage goes from 3 to 4 to 5 to 6 to 7 as the benefit rolls off, it's just an ARM.
Adjustable rate mortgage.
Yeah, sorry, it's just an adjustable rate mortgage. Look, you're old enough, and I'm old enough to remember that a traditional 30-year mortgage for much of my life, at least my adult life, it wasn't unusual for it to be 5 and 6%. And
that was a good rate.
That was not a bad rate. COVID, in many aspects, and we're still dealing with this, and both from on a personal level, all of us are dealing with it, and also the economy and finance. It threw everything sort of out of whack. Do I ever think we're going back to sub 3% mortgages in the United States? Probably not. And for anyone listening, you may not want that to happen, right? Because if we do, something else really bad has happened in order for that to sort of get to that point where we have to go back to that period. So, look, people were able to afford homes when they were 5 and 6 and 7. Yes, I have major empathy for millennials who are doing the first-time home buying, and suddenly it's gotten more expensive. We're going to have to work through this. Thankfully, rates have started to come down in the mortgage space, and we are seeing some green shoots. Remember that? That was the 2009 phrase that we used to hear back in the day, where I was starting to see some green shoots on the housing market. But they're still in a recession, which gets back to your other question. Are we heading into a recession? If you're in the home building part of the economy, or you're in the tech sector right now, guess what?
You're recession. Already there.
Yeah, you're already there. The tech sector has had massive layoffs. In fact, there was another one announced the day that we were taping this. I would tell people listening, or maybe I'll quiz you. Do you know how many people in the United States actually work for the tech sector on a percentage basis?
I'm going to guess 30.
It's actually 3%.
Really?
Yeah. Well, think about what they're able to do, right? They're the programmers. Twitter, Facebook. I'm just making up the most popular names, but they don't need a lot of manpower.
Right.
Go to the hospitals around here and see how many people it actually takes to run one of those places. So even though we're having massive layoffs, it's not the tech sector specifically is having layoffs. They don't employ a lot of people in America.
In 1988, national debt, the accumulated deficits since George Washington was president, to Ronald Reagan president year, was just over $2.6 trillion. President Reagan had a show and tell before Congress that year, and he showed the budget at 1,000 pages, just over. They made a real funny little story about it anyway. But right now we have the Senate debating an omnibus spending package that runs over 4,100 pages and will cost $1.7 trillion, and was supposed to address the funding the military, but it's become just another trough with the special interest groups and the lobbyists are going to feed at, that contains $772.5 billion in non-defense discretionary spending. The national debt is now over $31 trillion. Since Ronald Reagan was president, $2.6 trillion, now it's $31 trillion. And the Treasury Department reported the budget deficit for November, for 1 month, was $248.5 billion, with a B, up from $87.9 billion in October, just a month earlier, and $191 billion a year earlier. So I guess, the Treasury keeps selling bonds, the Fed keeps printing money. What effect does this dramatic increase in the supply of money have on inflation? We talked about the cost push. Now they're just shoveling money at the economy.
Yeah. So I guess I'll start with one of a personal source of some frustration, which is our President Biden gets up and talks about how we have to stamp out inflation, but a week later, we're talking about, student loan forgiveness. And it's like, yeah, but that would be inflationary in its own right. And I think that's what, without picking, each part of that bill apart, the reality is stimulus in whatever format it comes from the federal government can add to the inflation concern. Until we get our hands around the fiscal spending, the Federal Reserve, who's raising rates, again, trying to stamp out inflation, the reality is, we're hurting ourselves. And the Federal Reserve has a harder time the more that government spending goes up. Where's that equilibrium? I can't possibly begin to tell you. But the reality is, to answer your question, fiscal spending from the government, all things equal in a vacuum, does in and of itself create inflation. And when we're trying to stamp that out, it just makes it a little bit harder for the Federal Reserve. And the fear, let's bring this back to Wall Street. The fear is that the Federal Reserve, with each incremental rate hike, is more likely to break something, meaning they over-tighten, meaning they raise. We know that there's a lag. And the Federal Reserve admits this. There's a lag between a rate hike and when it actually works its way into the general economy. Right. I personally think that lag's not as long as it used to be, just because, cell phones and everything else, where and we're seeing, every time the Federal Reserve raises rates, I don't know if you're getting emails from your bank saying we've raised our money markets and all those other kind of things.
I get postcards.
Yeah, but the point is, I think it's quicker than it used to be, 20 or 30 years ago. But the reality is, they come out and say it's probably a 12-month lag. Look, if you're giving medication to a sick patient and you don't know for 12 hours whether or not it's going to kick in, what's an most likely output? You're going to over-medicate the person because you were waiting for the effects to kick in, and then when it finally did, you're like, oh my God, I gave him too much drugs. Maybe not the best analogy I've ever used in my life, but the point is, there's a fear that they over-tighten because they're trying to get out in front of inflation.
For many Americans, the barometer of inflation, as I'll call it, is how much they pay for gasoline. And on December 12th, the national average retail price for regular gas was $3.23.9. I still don't understand why gasoline is
quoted in third decimal.
But anyway, and that was, for the first time, lower than it was a year earlier. Now, Rhode Island, I just heard the average cost in Rhode Island last week was $3.30.9 a gallon. The cost of home heating oil was $4.55.8 a gallon, which was $1.21 higher than a year ago. And the Biden administration keeps blaming Russian President Putin for these increases, but is there more to it than that?
So, when Putin first invaded Ukraine, we saw a massive response in the gas prices because the assumption was Russia is a major producer of oil. Oil's the input for gasoline, and everyone's sort of just, oh my God, what's going to happen here? There's been two things that have helped the gasoline prices. The first one is the Strategic Petroleum Reserve and the fact that we opened that up and we've been flooding the market here domestically with the barrels of oil from our reserve. And the second thing is that China basically every other day is just locking down cities of millions of people. And so the demand out of China. Worldwide demand has gone down. In terms of the diesel fuel, there's a refining issue from what I've been told that is causing some of the issue. At the same time, Europe's trying to wean themselves off of Russian oil, and they're having the demand that we're getting is also fighting with them. For a very long period of time in the U.S., we've been blessed with really cheap energy, and the fracking revolution was a huge part of that. And then again with COVID, it's sort of threw that equilibrium out of whack, and it's taken some time for things to get back to normal. And just when they did, Russia just invaded Ukraine and threw it all into disruption again.
Last November, I think it was, the podcast that you and Laura Bard, which is called The Novice and the Nerd, and I'll leave it to your imagination which one is the novice and which one is the nerd. You talked about a very interesting topic, and that is the supply of natural gas and how important it is to the production of energy in Rhode Island. Renewable resources in Rhode Island only provide 10% of the energy. I think before the program, we talked about 6% from solar and 4% from wind. And the other 90% comes from natural gas. You pointed out on that podcast that the former New York governor bowed to the climate change activists and said, I'm blocking a pipeline across New York which would have brought natural gas, which is in abundant supply in the Allegheny Basin. Appalachian Basin, excuse me. It's on the other side of the Allegheny Mountains.
Yep.
Bring it in, but it'd have to go across New York State. He spiked that whole thing. And currently, I just heard a report this morning that Massachusetts Attorney General, soon to be Governor, Maura Healey, has confirmed a pledge that she will block 2 natural gas pipelines coming in across her state. Well, so far the winter's been relatively mild. But summarize what's going on, and could you tell us the implications of this issue?
Yeah, so let me start off by saying I have kids, you have grandkids. The shift to renewable energy will make my kids' life better and your grandkids' life better, right? I firmly believe that. What I do worry about, and what's somewhat being impacted here, is if you try to do it too quickly, what are the unknown potential issues? So let me just summarize what some of you said so that I can kind of go down a certain path.
Absolutely.
So in Rhode Island, 90% of electricity, we're using it right now, is being run off of natural gas that is coming traditionally through pipelines that start in Pennsylvania, go through New York, go through Connecticut, and then end up here. The pipelines are not big enough to support the demographic growth that has occurred not only in Rhode Island, but throughout the rest of New England. And in fact, it was only 3 or 4 years ago where apparently we were like a couple hours away from having rolling blackouts. So what is written into, and again, I'm not an energy expert, but I'm just telling, so if there's someone watching who knows more about this, I'm more than happy to hear it, but I'm giving the general overview, is that if there's a shortage, it's written that the natural gas has to be diverted to keep people from freezing to death.
Home heating.
Correct, right. Businesses and home heating. We don't want people to freeze to death, but you could sit in the dark. This is where it gets a little interesting. What used to be Natural Grid, which is now Rhode Island Energy, right? So they got these plants that need natural gas in order to generate electricity to keep the lights on. When the pipelines that are currently in place, they wanted to expand them. And they got approval. And then New York bowed down to the environmentalist group and saying, hey, we have certain mandates. We're trying to get zero carbon by such and such a year, and these pipelines are going to set us back. And so Cuomo, to your point, not Mario, but Andrew Cuomo, denied letting those pipes get passed through. So when there's a shortage right now, we have to ship LNG, liquefied natural gas. We have to get it off a ship from somewhere. This is where we run into a weird situation. It's called the Jones Act. Jones Act was passed in the 1920s, and it says if you want to ship anything, not just liquid natural gas, matchbox, toothpicks, whatever, if a port leaves somewhere in the U.S. and goes to deliver those goods to another port in the U.S., the ship has to have been built in the United States, it has to be owned by a company in the United States, and it has to be manned by people in the United States. We have not built ships to ship liquid natural gas in quite a long period of time.
Built ships for anything except submarines and so forth.
Well, I think there's something like 100 ships that fall under, that are Jones Act approved.
Okay.
Yeah, but not all of them are equipped to ship natural gas. So, believe it or not, when there's a shortage, Rhode Island Energy has to get the liquid natural gas from somewhere. They actually get it from Trinidad and Tobago.
Really?
We're shipping.
Oh, so it's coming from an offshore port, that port.
Right. So
Okay.
we are because of the Jones Act, we are not allowed, because we don't have the ships to ship LNG. We have to go out into the market, into the rest of the globe, and find other sources of our LNG. Right now, because Putin invaded Ukraine and because Europe is trying to wean itself off of Russian oil, they are competing for the same liquid natural gas that we are. And so New England, I believe every governor of the 7 states in New England sent a letter to Washington, D.C. saying, can you please repeal this Jones Act? Because we could get LNG from Texas, we could get it shipped here if they would just let this Jones Act go, and so far it's been denied. So the reality is, if we don't get enough LNG, they're gonna shut the lights off on us, and we'll be sitting in the dark. And all kidding aside, some of the major energy producers, Eversource in Massachusetts, has already said this could very well happen.
And I mean, we're talking about turning the lights off, but seriously, if the priority is to shift the natural gas to home heating use, I don't know exactly how they would do that, but that means you could have commerce come to a grinding halt because they don't have any heat.
Well, no, so again, as my research has told, businesses and homes will be allowed to heat themselves, but you won't be able to turn the lights on. So let me hammer this point home. The U.S., Russia's the #1 natural gas producer, U.S. is #2. We are like neck and neck. And Pennsylvania, if it was its own country, would be the 3rd largest. So we have a ton of this. What is it, a 5-hour ride we can get down to Pennsylvania? So we're all going to be sitting potentially in the dark because of A, we can't get the pipelines expanded. So these pipelines already exist. They wanted to expand them. Again, my kids, your grandkids will benefit from anything we take steps towards environmental. Don't kill me. I'm just the messenger.
Just the messenger.
I'm just the messenger. And because of the Jones Act, we are not allowed to find American sources of LNG. We have to go out into the rest of the globe and compete with Europe and other people who need that LNG, and we're paying in New England higher prices because of the fact that there's this act that was passed. Now, if there's anyone in the maritime industry who's watching, they're probably screaming at the television, yelling at me right now. It was originally passed because this was a matter of national security, and I get why they created it. It's been
national security after World War I.
Correct.
Okay. Well, we're almost out of time, but I hope people understand that all these moves have implications that I call it the law of unintended consequences, if you want. And we've got to address these because, as we said, or you said, and I agree, this transition to renewable sources is going to take time. And so I'm going to thank you, Derek, for coming on again. I hope we'll see you again. And
thank you for having me.
To our audience, I will say we are taping this program on the winter solstice. On behalf of everyone at State of the State Communications and the great staff at the PEG TV studio, we wish you all a very happy and healthy holiday season and new year. Thank you for watching State of the State.